Hello and welcome to Dreamface. If you glanced at your 401k this week and winced a little, you're not imagining things. Semiconductor stocks, the chip companies behind basically every piece of AI and tech hardware, have fallen roughly 20% from their recent highs. Netflix just posted a disappointing earnings report that dragged the broader tech sector down with it. And now, right in the middle of all that shakiness, some of the biggest companies in America are about to report earnings this week. Tesla, Alphabet, and Intel among them. So is this the beginning of a real correction, or just a rough patch before earnings season proves the doubters wrong? If you've got any exposure to tech or AI stocks in your retirement account, and let's be honest, almost everyone does at this point, you'll want to understand what's actually happening here. Let's get into it. Let's start with the numbers. The Philadelphia Semiconductor Index, the benchmark that tracks major chip companies like NVIDIA, AMD, and Broadcom, has fallen about 20% from its recent highs. That's the technical definition of a correction, not just a bad week, and it happened over a surprisingly short stretch of trading days, which is what really rattled investors. Netflix added fuel to the fire when its latest earnings report came in below expectations, and the stock dropped sharply in response, which rattled investor confidence across the entire tech sector, not just streaming, because it raised the question of whether other big tech names might disappoint too. At the same time, oil prices have been climbing due to the escalating conflict overseas, which adds another layer of pressure on growth stocks, since rising energy costs and geopolitical uncertainty tend to make investors less willing to pay premium prices for future earnings that are years out. So you've got three things stacked on top of each other right now: a chip stock correction, a disappointing tech earnings report, and geopolitical risk in the background pushing up costs across the economy. That combination is exactly why the market has felt shaky the past several days, even though no single one of these stories is entirely new on its own. Here's the deeper story behind the chip sell-off, and it's worth understanding because you'll hear this term a lot this year: the AI rotation. For the past couple of years, chip and AI-adjacent stocks have been the market's biggest winners, pulling in enormous amounts of investor money on the promise that artificial intelligence will transform every industry. That's created sky-high valuations. Stock prices that assume years of flawless future growth are already locked in. When a sector runs that hot for that long, it becomes especially sensitive to any sign of disappointment, because there's very little room for error already priced in. Some investors are now rotating money out of these high-flying AI and chip names and into other areas of the market: energy, value stocks, or simply cash, as a way to lock in gains and reduce risk. This doesn't necessarily mean the AI story is over. It often just means the easy, uninterrupted gains phase is over, and the market is becoming more selective about which companies actually deliver. This is exactly why the timing of this week's earnings reports matters so much. Tesla, Alphabet, and Intel are all reporting in the coming days, and each one is a genuine bellwether for a different part of the tech story. Tesla for EVs and automation, Alphabet for the broader AI and advertising economy, and Intel for the health of the chip industry itself. Strong results from these companies could calm nerves fast and reverse some of this sell-off, because it would show that the fundamentals underneath these stocks are still solid, even if the price action has been rocky. Weak or disappointing results, on the other hand, could accelerate the sell-off further, especially in a market that's already nervous and looking for reasons to keep taking profits. This is actually a genuinely interesting moment in the market, a real, data-driven test of whether the AI and tech story still holds up, happening in real time over the next several days. Now let's bring this back to you. If your 401k or brokerage account has taken a hit this week, here's the honest context. Most target date and diversified index funds have meaningful exposure to tech and semiconductor stocks, simply because those companies have grown to be such a massive share of the overall stock market. A handful of tech giants now make up a bigger slice of the S&P 500 than at almost any point in market history. That means a correction like this one will show up in your account balance, even if you've never bought a single chip stock directly and have no idea what half these companies even do. This isn't necessarily a reason to panic. Corrections of 10 to 20% in a specific sector happen periodically, sometimes more than once a year, and the broader market, the S&P 500 as a whole, has held up far better than chip stocks, specifically because it's spread across dozens of other industries too, from healthcare to consumer goods to financials. That spread is diversification, doing exactly what it's supposed to do, cushioning the blow from any single sector's rough patch so one bad week doesn't derail your entire retirement timeline. So what's the actual move here? For most of you, especially if you're investing for a retirement that's still years or decades away, the answer is refreshingly boring. Do nothing dramatic. Trying to time a sector rotation or guess which way earnings season will swing is a losing game for almost every individual investor. Even professional fund managers get this wrong constantly. What you can do is use this week as a prompt to actually check your allocation. Look at how concentrated your 401k or brokerage account is in tech and AI-related names, and ask yourself honestly whether that concentration matches your risk tolerance and how close you are to needing that money. If you're in your 40s with 20-plus years until retirement, some volatility in a hot sector is a normal part of long-term growth investing. If you're closer to retirement and heavily concentrated in tech, this might be the nudge to talk to a financial advisor about rebalancing toward a more diversified mix. Here's the bottom line. Chip stocks have fallen into correction territory. Netflix's weak earnings shook confidence across tech, and this week's results from Tesla, Alphabet, and Intel will be a real test of whether the AI story still holds up. If your 401k dipped this week, you're not alone. And for most long-term investors, the right move is patience and a quick gut check on your allocation, not a panicked reaction to a single rough week. If breakdowns like this help you make sense of what's actually happening with your money, hit subscribe. Every Thursday, I cover the financial news actually worth your attention. See you in the next one.